too. So good afternoon, everyone. Welcome to Argent Bridge Coffee and Conversation. My name is Cecile Holtz. I am a partner and private wealth advisor with Argent Bridge Advisors. Today's topic will be around medical insurance pre-Medicare. A lot of people are covered under an employer-sponsored plan, but some people end up relinquishing their employee-provided coverage for various reasons. Might it be divorce, unemployment, early retirement, starting a business, becoming self-employed, and so on and so forth. So today we will be talking about insurance options that are available to them. As a side note, all of our webinars are recorded, so you'll be able to listen to a replay if you have to hop out at some point. It's on our website, argentbridge.com. So today I'm delighted to welcome a medical insurance expert, John Katz. John is the principal and founder of Virginia Medical Plans. He has 30 years of experience providing insurance solutions for individuals, families, small businesses. He's helped a number of our clients over the years, and he's been a wealth of resource to us for any insurance related questions. So John, welcome, and thank you for joining us.
Oh, it's my pleasure. Thank you.
And if you don't mind, this will be very conversational and casual, and I will be asking you a few questions. We're going to aim to basically have a 30-minute conversation and go through all the questions. And at the end, we'll make sure to address any questions that any of you on the call have. So really, thank you to everyone on this call for joining us, and hopefully you find this of interest. So John, I was mentioning we're going to be talking about insurance coverage that is for people who are not covered by an employer. So what is out there? What is available when you don't have an employer offered coverage?
Yeah, so great question, and a great way to kick it off. There's a whole range of options, potentially, depending on what the individual situation is. And our process is just to start asking questions. Primarily, we'll want to know what someone's coming from. So if they're coming from an employer, they're leaving an employer, we're going to want to know if there's going to be a COBRA option, the federal law that says the employers allow you to continue the coverage business as usual for up to 18 months, or if it's a smaller employer, what they call state continuation. So we'll want to know that if they're moving, new to the country, if they're moving from another state, if there's just such a long range or a wide range of options.
Right.
And we're going to, if in fact they are coming from an employer and there is the ability to extend employer coverage, we're going to want to look at that to compare it against what's available in the non-group individual family market. And if they happen to be self-employed or their spouse is self-employed, potentially a small group plan.
Okay. What about COBRA? It's great to have the ability of continuing coverage, but what are the drawbacks? Like, what would make you basically say, hey, yeah, stay on COBRA as long as you can, or encourage someone to look for something else?
Right. So that's a great question too. And it's an interesting one that it's changed. The answer's changed in the last couple of months under the American Rescue Act that was rolled out about three and a half, 4 months ago. In that, before the American Rescue Act, the people that were able to get subsidies, individuals and families that were able to get subsidies, were a much lower threshold, meaning financial help to buy a personal policy, a non-group policy in the individual market. With the American Rescue Act, it greatly expanded who would be eligible for a subsidy. So for example, if I'm a family of 4, before the American Rescue Act, I would have to make less than roughly $104,000 modified adjusted gross income to get any help. With the American Rescue Act, it expanded who can get help to anyone so that a family can't spend more than 8.5% of their modified adjusted gross income on the least expensive silver level plan available in their state. So in other words, you could have a family of 4, depending on their age, that could be making up to even $225,000, $250,000 and still get some kind of help.
Interesting.
So to go back to your original question, why I bring this up is that COBRA was a lot more attractive when for people that were over the threshold that weren't eligible for a subsidy, but now that a substantially larger
More
group of
people
people
are
are
available.
eligible,
Yeah.
we really want to look a lot closer at what their expected income is, what the benefits are, and what the pricing is of Cobra.
Interesting. And what is, sometimes when clients do look into options, they're confused about, the marketplace versus private insurance, Obamacare. What can you make sense of all of us for us?
Such a, yeah, very common question. At this stage of the game, 10 plus years into Obamacare, in Virginia, Maryland, and DC, which is where we operate primarily in the individual family market, there is no such thing as a differential in carriers. There's some minor differences in plans at the so-called silver level, but that's very parenthetical. There's no difference in carriers available so-called off the exchange or on the exchange.
Got it.
So if I'm going to buy through, when we talk about on exchange, means some people refer to it as the marketplace. Some people will say healthcare.gov. In DC and Maryland, it's so-called state-based exchanges, but the idea is the same. There is no Obama plan. It's all private insurance companies, and it's the same carriers on or off exchange. Why I would want to buy it on exchange, especially now more than ever, is because I might get some kind of financial help to buy my personal policy.
Got it. Good. And that makes it very clear. So another thing, to throw another option in there, I'm very curious to hear your take on this, because I heard about this recently, didn't know it even existed until someone brought it up to my attention. But I've been hearing that because the cost of insurance is so great, that some religious groups or associations have been getting together and basically creating their own insurance pool. And so typically the premiums are less than a traditional insurance, but I'm just curious about the benefits, right? It's
Right.
usually you don't get both, like a cheap premium and then a good insurance, right? What are your thoughts?
Yeah, I mean, traditionally these things are called Christian share programs, and they're basically ministry-based plans that are exempt from really much regulation or any regulation at all. They're not regulated at the state level. So they are if you read brochures, if you look at the materials they put out, they're very, very careful. They don't call it insurance, they call it a share. They don't call it premiums, they call it donations or contributions or whatever. They're very, very cute about the language that they use. And it is, the fact is that under the Affordable Care Act, insurance companies have to pay at minimum under what they call the medical loss ratio. They must pay 80 cents for every dollar they take in. They must pay 80 cents in the individual family market out in benefits. And if they don't, people may have seen over the years that they receive a rebate in August of the following year. Now, this is not on any individual one family. It's everyone in a particular carrier in a state. And the reason I point this out is that even though I'm not going to say insurance companies are perfect, no one's going to argue that,
Right.
or loved for that matter, but they are heavily regulated. And regulators in Richmond and Annapolis and in DC, they're paying attention, making sure the insurance companies are meeting minimum loss ratio requirements and processing claims and have comprehensive plans that don't have exclusions for particular situations. It's all heavily regulated. It's the Wild West with the Christian share plans. And you'll see stuff like they don't cover outpatient prescriptions. You'll see stuff like, well, an out of wedlock pregnancy. Well, that's not part of the tenets of the Christian share plan, or
Right.
mental health benefits. You'll see stuff like, well, maybe we'll only pay up to $50,000 for hospitalization.
Wow, which is nothing,
Which
right?
is nothing
Right.
versus unlimited until Blue Cross or Cigna or whatever carrier runs out of money. So I think that they sound great if you want to say that you have a plan, and but if what I think that this is common with any insurance, no one's a better expert at their plan until they have a major claim. Then
Right.
they're an expert. And that's not the time to find out that
Yeah, it's too late by then.
that you're not truly protecting. You work too hard for the assets that you've built up, with you guys, with your advisor and whatever. And why do I want to put my financial life at risk?
Right. So it doesn't sound like it would be your recommendation to go that route.
No, never, ever. As I say, I wouldn't insure a dog with one of those plans. A dog
Oh.
I don't like. I like dogs.
So tell me about logistics. That's another question we get a lot. I'm about to lose my employer provided coverage for whatever reason, and I need a new insurance plan. Like when do I need to apply for the new plan? Where do I apply? And so on and so forth.
Yeah, so that's a great question. If I know that I'm losing my coverage, and going back to the American Rescue Act, it is there's interesting little twists in that, because if you were laid off, your COBRA is going to be free through September 30th, to the end of September. And this went back to April. So anyone that was laid off, regardless of their income, had free COBRA or state continuation through the end of September. If they were laid off and they became eligible for unemployment, then they're eligible for free non-group coverage all the way through the end of the year.
Oh.
So we really want to look, and regardless of income. So if I'm a person, let's say I'm making $25,000 and my spouse is making 500,000, I get laid off and I'm offered unemployment because the company I'm working with went out of business. I'm offered unemployment. So the idea is that regardless of our family income being $500,000 or whatever it is, we're going to have the ability to get a so-called silver level plan with no or minimal premium, with no deductible or maybe a $50 deductible all the way till the end of the year. This is under the American Rescue Act. So if you call my office and said, hey, I'm about to lose my job, one of the first questions I'm going to ask you is, well, did you voluntarily leave, or were you laid off? Is unemployment involved? Because, gosh, free is a great price, at least until the end of September. And then we'd want to look at doing an individual plan. If that's not the case, if I'm voluntarily leaving, then I'm going to suggest that it's helpful a good 30 days before I'm going to lose coverage to start exploring what my options are. And of course, we have people a lot of times.
In fact, I'm sure.
Well, we have people like coming from financial planners primarily, outfits like y'all's that are very intent on planning, and they might say, hey, I'm thinking about in 2 years leaving.
Oh, okay.
What's
Much better.
Right. I mean, it's and we'll have conversations with them as a courtesy.
So that's too early.
It's a little early, but what I would say to a family like that, because again, these are the kind of calls we get from financial planning outfits, is let's look at what the premiums would be if at the age you plan to retire. Let's not worry about subsidies unless you know your income's going to be low, especially because we know the American Rescue Act is going to sunset at the end of next year. And I'm going to say let's inflate by 10% what the premiums might be each year, which might be a little bit overkill, but it's a safer way of approaching. You're not going to be surprised, and if you are, it would be pleasantly.
Okay.
So I'd say 30 to 60 days would be appropriate, but obviously people like to have those conversations a lot sooner in some cases.
Right, and I think that the reason people like us planners like to reach out to you is to at least get an idea of how much it is going to cost. So I'm sure you probably hate that question because it's probably really hard to say, but what kind of range can people expect when they go to their own insurance? Like if they're an individual, if they have a family, like what ballpark are we looking at?
It's a fair question, but it's such a wide range. I'm going to need to know.
Dependent on coverage, of course.
Where do you live? Maryland's the least expensive by far, and in the 3 jurisdictions. Where do you live? What's the makeup of your family? Ages? Do you guys smoke or not? And what your income is going to be. I mean, knowing what your modified adjusted gross income is likely to be is critical to know how much your health insurance is likely to cost? Such an important question. And, the other piece is if I'm maybe COBRA, COBRA rates are based on, in most cases, the average age and health of everyone that was at the company, especially I'm coming from a larger employer, the average age and health of everyone that was at the company that I used to work for. So if I'm 64, my spouse is 64, and I'm leaving a company, and I was at a software company that the average age is super young people, 25 years old. Well, those rates are going to be absolutely fantastic for me as a 64-year-old. They're going to be unbelievable. But let's say the opposite's true. I'm coming from, working for a county government, and the average age of the county government is 55. It usually is a little older than what you normally see in business. And I'm 25 years old. My spouse is 25. Well, COBRA might be exceptionally ridiculous versus what I can get in the individual market. So age matters, income matters, and then demographics of the company I was working for can matter too.
Yeah, it's interesting you bring this up, because I think oftentimes people default to their employer for coverage, but I'm assuming if you're young and healthy and your employer is not necessarily going to subsidize a lot of your benefit, do you think there's an instance where people might be better off on their own?
Yeah, so it's a wonderful question too. I'm just going to actually blanket say that all of your questions are going to be wonderful, and I'll stop making that comment before I answer them. So, but to the question, it's complicated because first off, if I am eligible for so-called affordable coverage at my job as an individual, meaning that my employer doesn't make me pay more than 9.86% of my income for me as a person, as an individual, regardless of what my family is going to run, I'm considered under the Affordable Care Act to have affordable coverage offered to me at my job.
Okay.
Which means that, let's just say that I work for you and you're paying me $40,000 a year, and I have a family of 4. Right? And our total family income is 40,000, very, very moderate income. And you're giving me my insurance for no cost. Well, I'm offered affordable coverage at my job. But let's say for my wife and 2 kids, it's gonna cost me $1,700 to be on your plan. I'm offered affordable coverage at my job. I'm not eligible for a subsidy under the Affordable Care Act. So yes, I can go and buy a plan, but it's not going to be subsidized regardless of my income. And I'm going to use after-tax dollars to pay the premiums versus if I buy it through you, it's going to be pre-tax. So this creates some big problems for moderate income families. It's called the marital glitch or the family glitch in the Affordable Care Act.
Yeah, it's fascinating. So I think you're already answering that question through all the good information you're providing, but what are the benefits of working someone like you versus just getting quotes online? Or is there any downside? I'm sure you're not going to say no, but anything that I'm not asking that would make it a benefit?
It's funny is people will ask that question to us. They'll talk to us for maybe 20, 30 minutes. We're going to get their situation. We'll figure out.
Get their free advice and then go online.
No, not necessarily. But then and I really appreciate the question because, just like you guys have, no one works for no cost, but we all try to offer value and be productive, et cetera. But in our world, in the individual family market, if you have an agent involved or not, the price is the same. There's no differential by even a penny. So someone will say to me, and I really appreciate the question because I don't want people to wonder, right? Because inherently people will think, oh, if I use an agent, it's going to cost
more expensive, right?
And so I turn it around. They'll say, and again, I appreciate the question when they say, well, John, gosh, I appreciate the information. It was really helpful. Now I understand what my options are, whatever. But why should I buy through an agent? Why should I do that? And I kind of have to laugh every time. And I say, well, let's kind of turn this around. It's not going to cost one extra dime. You're never going to have to call a call center. You can always call our office for support and advice on the plan and claims questions, et cetera. and I asked them the question, why wouldn't you use an agent? Like,
Mhm.
if they know, if they're once they're educated to know that the price is the same, it really turns it around. And frankly, I kind of, and I'm biased, of course, but I feel bad for people that don't have agents.
But
A
that's so
lot of stuff that can go
complicated.
wrong. Right. Like everything in the world, you know.
Definitely. So let's say someone comes to you and, you know, basically tells you this is my current coverage, I'm going to lose it. How do you go about comparing plans? Like, what do people, how prepared do people need to be? How do you help them reach the right decision and the right plan to choose?
Yeah, so we'll go straight to, you know, after we've established that they should even be looking at individual coverage, or if we're going to encourage them to stay on COBRA, or if
Mm-hmm.
Medicare should be involved, depending on ages, et cetera. Let's say we moved into this situation that they need to buy their own insurance. Well, one of the things that we're going to look at is also, and I think this is really critical, is the network access. Making sure that they have the right providers, the right medical providers and hospitals for what they anticipate their needs might be. And if they don't know if they're in great health, we're still going to always default to the widest list of doctors and hospitals, right? So I would much rather have a plan that has the broadest network of doctors and hospitals than one that's the most constricted, because I don't want that call that I can't find an oncologist or, someone I really need. So we'll look at that. And then we, ask them obviously what doctors they see, and we want to make sure that matches up.
Okay,
That's straightforward enough.
got
And then it comes down to price and trying to figure out benefits, that makes sense for their anticipated needs. But the worst plan that I can buy that's Affordable Care Act compliant, even if I have a $7,000 individual deductible double for family, gets me catastrophic protection. It's not worthless.
it. Mm-hmm.
It's actually quite it can be quite comforting to have a safety net, know what my total exposure is going to be, and protect the financial life that I've built up through Argent, for example.
Okay, good to know. Um, I was going to ask you that question. If I'm going to change plans, does that mean I need to change doctors? But you're saying like that would be one of the things you would start with, kind of solve it backwards. Like, what are your doctors? And let's make sure that your doctors are within that network.
Right. And
Okay.
sometimes people have to compromise, that they might have to, sometimes you just can't get all the doctors that someone wants to see. And a great example of that is here in Virginia. Most parts of Virginia, there is no such thing as a national PPO. There's only various types of HMO.
Okay.
So there's no plan that one can buy in almost all of Virginia, with the exception of just the inner suburbs, that would allow them to go to Georgetown or Hopkins, or they have to so inherently you may have to accept compromises. And this could be a reason. Back to your other question about COBRA, I might say, well, gosh, I'm in the middle of, I don't know, cancer treatment, and I need to continue at Georgetown, or I think it's going to impact my life. So I might say, okay, fine. Why don't we carve you out? Why don't you take COBRA, and then we put your spouse and children on an individual plan.
Wow. Okay. So you can be very resourceful that way. Yeah, you were mentioning Virginia. What happens when you move out of state? This is such a transient area, so I'm sure people move in and out of the state.
Yeah.
Does that mean that they need to replace their policy? What happens then?
You're right. What ends up happening is the health insurance is regulated at the state level. And so if I move out of Virginia or DC or Maryland for that matter, I have to buy a new policy. I can't continue with the plan. Even if I have, and it's easier to do in DC and Maryland, national PPO network, the coverage is based in that jurisdiction. So I'll have 60 days to buy a new plan in the new jurisdiction I moved to.
Got it. What about your firm? Which areas do you serve, and where are you licensed?
Right. So for health, we're licensed in a bunch of different states, but for health insurance, we only deal with Virginia, Maryland, and DC, and that keeps us plenty busy. It's
Probably.
Yeah,
Probably a
and
full-time job to figure out each state's rules and plan.
it really, and the plan benefits are so wildly different between states. Even if the carrier is the same carrier, the plan benefits can be wildly different.
Got it. Okay. Well, it's almost already been 30 minutes. So I want to take a pause right here and just open it up for anybody on the call who has questions. So if you have a question, feel free to submit it in the Q&A section, and then we'll make sure to ask John that question. Now I'm seeing lightning.
And we're happy to answer questions offline as they come into you. So if your clients come to you later, as always, we're happy to have that preliminary conversation.
Sometimes we do actually get that question. Someone will have, different options within their employer provided plan. Do you ever help with that? Or is it more when people, I mean, like I probably wouldn't be compensated on that, but.
Yeah, that's a tough one. I mean, we definitely get those, and if someone calls, we'll answer it, but it's not, it would just be as a courtesy.
Okay.
And frankly, it would probably be more appropriate for someone to ask their HR department, or if it's a smaller company, there was a broker involved in setting up that plan, and they should have
Great point.
that's better knowledge than us from the outside.
Okay, well, I'm glad I asked that question because that gives us some information about that. We do have one question. Someone is saying, what is the look back period for the adjusted gross income when switching to Medicare?
Oh, that's a good one, because when I switched to Medicare, the government's default is a running 2-year look back to determine how much I'm going to pay for Medicare Part B, the part of Medicare outpatient physician services, the part that I pay for. However, so for this year, if I was to retire now, go on to Medicare, my Medicare Part B premium is going to be based by default on 2019. And then in January of next year, automatically, they'll start looking at 2020. However, if someone's retired and they've left a job, for example, and their modified adjusted gross income is expected to go down, then there is the Social Security Administration, has an appeal form that they can file. And I heavily encourage people to be aware of that and to do that. Otherwise, it'll take 2 years to catch up, and the government won't refund those extra premiums.
Oh, interesting.
Mm-hmm.
Is the opposite true when your income is going to be higher in a year? Should you proactively tell them or not? Like, for instance, sometimes someone will sell a house and have a huge capital gain in that year. Is it worth being proactive, or do you wait until you?
Right. It's yeah. So capital gain that's a different situation and also appealable. But if, let's say that my income, I'm working, or maybe I'm self-employed, and my income is going up substantially each year, well, then I'm just going to wait for the 2-year trail. I'm going to wait for it to catch up with me, because I don't need to tell them that my income is much higher. It's not the rule, and the rule is the 2-year look back, rolling 2-year look back.
Got it. Okay, thank you.
Sure.
I don't see other questions, but I guess, we'll just leave it open-ended for Medicare. So since I don't want to get into anything Medicare related, but when it is time to apply for Medicare, when should we contact you, or how early do you need to apply?
Yeah, so it depends on their situation. If there's two enrollment periods for Medicare. Actually, there's 3, but 2 that apply to most people. The initial enrollment period, which is 3 months before the month I turned 65, my birth month, and then 3 months after. So it's a 7-month window.
Okay.
3 months before my birth month, 3 months after. And then there's what they call the special enrollment period. And the special enrollment period is after I was to leave my employer. I've worked past 65 in 3 months. I'm outside of this initial enrollment period, the IEP. And then I'm in the special enrollment period, and I can apply for Medicare at any time to coordinate with the end of my employer-based coverage. So I think that that's, some Medicare is a funny one, and everyone's situation, just like individual, can be a little different. So usually it's best to sort of talk out that strategy if they know they're going to be making a job transition.
Sounds great. I think the last question will be relevant to end this call. Someone is asking how to have a consultation with you, how to reach out to you. And I'd like to say, as a follow-up to this email, we'll definitely be sharing your information with everyone on this call, but feel free to mention your contact information here too.
Absolutely. So our website is vamedicalplans.com, and our phone number is 703-707-8270. And it's usually advantageous, or I think ideal, to involve your agent and your financial planner in that. Maybe start the email trail with them so they're aware of what you're doing and what you're thinking about, and of course they know how to reach us as well, and can be involved in the conversation.
Great. Well, very educational. Definitely learned a lot of things today. So thank you so much for your time, John. And as a reminder to everyone, we'll definitely be posting this webinar on our website as well as other webinars. So feel free to, if you forget about something that we mentioned today or went too fast over a concept, you can definitely hear the replay. But also want to thank everyone on the call today, and have a great evening, everyone. Thanks again.
Thanks very much, Cecile. Bye-bye.
Bye.